Okay, I'm going to start. Good afternoon. I'm Steve Kirshner, founder and CEO of IREON, and the Chief Operating Officer, Global Representative of Principals Direct Group. IREON is a non-compete business development association comprised of the highest quality products and service providers serving the real estate industry. All members are New York Metro based, and some of them are they're all New York region based, and several are being national and international in their business reach. It is IREON's pleasure this afternoon to host today's U.S. Hospitality Educational Forum with three leading industry experts. Speaking today are Daniel Lesser, co-founder, president, and CEO of LW Hospitality Advisors. Dan Lesser has years of specialized worldwide experience in the hospitality industry. Spencer Davidson, Senior Vice President of Hunter Hotels. He has worked on more than 5.5 billion in capital market transactions across the United States, representing hotels across all market segments on behalf of institutional, corporate, and private investment clients. Joseph Delli Santi, Chief Financial Officer of MCR Hotels, responsible for leading the company's acquisitions, development, and capital market activities. MCR Hotels has become the fourth largest hotel owner operator in the United States. They have a $3 billion portfolio. So I'm now going to turn the forum over to Dan Lesser to start. Go ahead, Dan.
Great. Steve, thank you so much. Really appreciate the invite, and pleasure to have Spencer Davidson and Joe Delli Santi join me on this. I think what we're going to do is each one of us is going to take about 10, 15 minutes and give remarks as to what we're seeing from our perspective. I'm gonna do a quick SWOT analysis: strengths, weaknesses, opportunities, and threats. Given that I'm an optimist at heart, I finish with opportunities last and not threats. And then Spencer Davidson's going to talk a little bit about the hotel transaction market, nationally, and then Joe is going to talk about from an owner-operator's perspective, what the sector is looking like. So again, thank you so much for joining us. So let's just take a quick minute and talk about what some of the strengths are about the the U.S. lodging sector. Every day the three of us are always asked, what do we think is going to happen in the near future, right? Well, my standard answer is you tell me what's going to happen with the economy, and then I can tell you what's going to happen with the lodging industry, right? The fact that hotels lease up guest rooms on a daily basis, and with technology being what it is, the pricing of rooms literally changes by the nanosecond, right? In a good economic environment, that's a beautiful thing. In a down economic environment, it can kill you, and very quickly, right? It cuts both ways. So listen, there are a lot of I'm not an economist. There are a lot of mixed signals out there about the economy and what's going on. The fact remains that GDP in this country is still growing, and the outlook for the next couple of years is continued growth, albeit at reduced levels, but it's growth nonetheless. So that's a real positive for the sector. Unemployment is at record lows. Wage increases are strong. People have money to spend, still funds left over from government handouts during the COVID pandemic. Leisure travel has been on a tear in terms of rebound post-COVID. And while that segment is slowing down in terms of that rebound, it's still very, very healthy. People want to travel. There's no question about it. And group meeting and convention business is also coming back real nicely, as is corporate individual business, which has been the slowest to come back. And candidly, that's because people are working remotely. Foreign visitation is now finally back as well, because coming up in May, it'll be a year since the U.S. ended COVID-19 restrictions. Room rates in the lodging sector are increasing at a very nice clip, and that's really where the majority of the rebound has been. Less so on the occupancy side of the equation. And what's interesting is that in past downturns, the sector had a bad habit of cutting room rates with the notion that by doing so, you'd put heads in beds. right? If you think about it, during COVID, you could have been giving rooms away, and people were not traveling and did not need nor want to stay in hotels. Let's see what else. Notwithstanding increasing expenses, which I'm going to talk about as sort of a weakness, the sector has really done an outstanding job in terms of operating efficiencies, productivity, and candidly profit margins. So the lodging sector is in really good shape. There's a limited amount of construction financing available. I'm sure Spencer will talk about this a little bit as well. But the bottom line is that it's not that easy to finance construction of a new product today. So for existing owners, that's a pretty good thing. You know, another thing to sort of remember too, and it is a strength for the sector, is that, you know, COVID was definitely a catalyst for removing many, many functionally and physically obsolete hotels throughout the nation, particularly in downtown major urban cores, that candidly reached the end of their economic life. So, you know, folks in the sector tend to look at new supply, but you really need to look at net new supply. And we've had a rash of hotels being converted to alternative uses and or scraped to become vacant land. So, another sort of strength for the sector. Institutional investors, there's a tremendous amount of cash out there. That a lot of it remaining from the COVID days when everybody expected mass distress and incredible opportunities that candidly never bubbled up. So that money is still out there, as well as other money that's seeking yield. And in a high inflationary environment, you know, this money is under pressure to get out and get deployed. You know, debt is, it's funny, people say debt's not available. Debt's available. It's just that you have to pay for it. It's expensive today compared to what it was, 18 months ago. But there is debt available. And, you know, I'm sure, again, Spencer will talk about this. And again, there's just copious amounts of institutional money out there seeking yield. So now let's just segue over to some of the sort of the threats and the weaknesses. You know, there's constant warnings of economic recession, depression, what have you, right? This week now we're dealing with the bank calamity and whatever the fallout is going to be from that. You know, rising interest rates, while U.S. consumers are still feeling pretty good and still spending money, you know, continuation of rising interest rates is not necessarily a positive thing for consumer mentality and the housing market. So that's clearly, you know, goes in the category of weaknesses and threats. The United States has had and continues to have terrible barriers for foreigners to obtain visas to come into the United States, and it's turning a lot of folks off, both in the business segment and in the leisure segment. That's something that really needs to kind of get addressed because it's hindering inbound travel into the States. Office, I don't need to talk about office. I think everybody knows it's really hurting, particularly in the downtown core. Candidly, I believe that, the notion of us getting back to return to office pre-COVID is never going to happen. And so that's clearly a ding for the lodging sector. Inflation has definitely and continues to place upward pressure on operational expenses. Higher interest rates are creating refinancing risk for billions of dollars of CMBS hotel debt that's maturing in the next 18, 24 months. You know, supply chain disruptions are still with us, and that affects doing renovations on hotels, which there are still many, many hotels that sort of kick the can down the road during COVID to implement product improvement programs, or PIPs, PIP. And the cost of it's going up, and the ability to get goods is still not easy for many locales and for many products. And the brands at this point are no longer playing nicely in the sandbox. Candidly, nobody's playing nicely in the sandbox. You know, during COVID, it was sort of from left field, and everybody sort of understood, hey, you know, this is nobody's fault. But now, you know, lenders are doing what they need to do to enforce their remedies, and brands are also, you know, mandating that properties undergo renovation if in fact they need it. Labor shortage. I mean, there is not an industry in America that is not facing a labor shortage. And it's clearly been a factor for the lodging sector. It's not the sexiest business to work in. And a lot of folks who were in the business and the operational end of the business pre-COVID moved on to other areas and are frankly enjoying those opportunities and in many cases making more money than they did working in hotels. Hotel property tax burdens and insurance costs continue to rise, and they're rising at very fast clips. That's clearly a weakness and a threat. And then cyber criminal activity in the lodging sector is big problem, and doesn't seem to be getting any better. Just sort of wrapping it up here, some of the opportunities, I mentioned earlier, with the ability to continuously change, reprice room rates, investing in lodging assets during an inflationary environment is a terrific opportunity because hotels are fundamentally good hedges against inflation. Now that foreigners are coming back into the United States, and as inflation is rising and foreign money is looking for a safe haven, and irrespective of all the challenges the United States has, it's still the greatest country in the world and the safest planet to invest in the world. And everybody wants to visit here and invest here. And we're seeing a fair amount of foreign capital re-entering the space due to a pause because of COVID. The wave of debt maturities that I mentioned, that's going to render terrific opportunities for, fresh capital. I mean, just think about how many deals were done, 3 to 5 years ago at interest rates significantly below where they are today. So when these loans mature, it's going to be a real challenge for sponsors to figure out what to do. So that's going to create tremendous opportunity. The major urban markets, there's a lot of opportunity in those markets, and maybe Joe will talk a little bit about that. I'm fond of speaking about, in my mind, the poster child for that would be the Sheraton Times Square, which Joe's firm MCR purchased for, if I'm correct, about $200,000 a room. Now it's a huge asset. So the gross sale proceeds were over $370 million, which is a lot of money. But on a per pound basis, $200,000 a room for that hotel, the Sheraton Times Square, I mean, you couldn't replicate it for multiples of that. So we're seeing more and more opportunities bubble up in, similar to that, and smart money is really sort of looking to that. Leisure travel, it's a term that I hate, and then leisure, combination of business and leisure. But the fact remains that, post-COVID, folks are definitely taking advantage of being able to work remotely, and they're combining business trips with leisure activities, right? It used to be that Thursday was the checkout day for the hotel sector. Now Thursday has become sort of the check-in day, right? You do your business Thursday and Friday, and then wherever you are, you party Saturday and Sunday. Group demand, I mentioned earlier, is coming back. And as group and business continues to come back, it's only going to enhance the pricing power of hotel operators as time goes on. Technological advances are being embraced by the sector. The industry has always been sort of a little bit slow to react to technology, but given COVID and the challenges associated with labor, the sector has really been forced to embrace technology, which is a really good thing. And then the last opportunity I would say is that the short-term rental market, while clearly being a competitor, is fielding some challenges. If you just sort of Google some of the issues that Airbnb is having these days, I think it's become clearly defined that you always sort of risk staying in an Airbnb, right, as opposed to a branded hotel. You kind of know what you're going to get. So that's kind of my high-level overview, and I hope I didn't take too much time. Steve, I don't know. I was thinking maybe we hand it over to Spencer.
Go right ahead.
Yeah.
Thank you.
Thanks, Dan. I think you covered a healthy amount there, whether it be from demand or transactions and trends. So appreciate you digging in. From a transaction perspective, it's been an interesting year, 2 years, 3 years, whatever you want to call it, but most recently a couple months. So, I think I'll focus a little bit more on what transpired last year and what's going on now. Last year there was approximately 46 billion in hotel transactions that were executed during 2022. From 2021, just to give you an idea, the price change of those average transactions were up about 6.5%, but the year-over-year volume changed it was basically flat, but negative 1%. Where we started to see a lot of areas of concern were really Q3, Q4, when interest rates started to accelerate. I think we had 7 Fed interest rate hikes last year. What that did to the cost of capital is tremendous. And, as Dan pointed out, right now, inflation has been a hotel owner's best friend to some extent. I believe the statistic is on average, hotel revenues outpace the average inflationary period by 3 to 5%. So to Dan's point of ADRs, average daily rates, increasing at a tremendous clip, we are seeing that right now. Revenues are arguably higher than they've ever been in some of the strongest markets across the country. The fundamentals, as Dan pointed out, are certainly strong, but it makes it for a very challenging transaction market. And going into November, we saw transactions down about 30% for the month of November 2022, down about 40% year over year in December. And for January, where I think traditionally deal volume has averaged about 2.9 billion in the past 5 years in a pre-pandemic level, activity to start 2023 was 51% below that pre-pandemic norm. So I know I'm throwing out a bunch of statistics here, but I think what's very important to keep in mind is the transaction market has certainly slowed. To Joe's dismay, what was a 7 cap 360 days ago is now being evaluated by the investment community at 8+, maybe 9+, in some case 10+ cap rates, simply because the cost of capital has almost doubled during the point of that time. Needless to say, there has been an inundation or influx of capital into the space, whether that being regional owner operators, private capital, institutional funds, or what we'll call new money into the space. So that's groups who may have been interested in office or industrial at some point in time, have since gotten squeezed out of that industry and are attracted by the cap rates that hotels still offer. So we are seeing activity. A lot of the institutional groups have been priced out from the traditional limited and select service style deals. So anything that's not full service, large scale restaurants, categorized as specifically limited service. Their cost of capital from the institutional investor community has gone up considerably. And so where deals are largely getting done today are from operators or owners with very strong relationship lenders. Now those could be portfolios, individual properties as well. Hunter Hotels, we transacted about 2.5 billion in transactions this year, but we are certainly facing headwinds this year. Regardless, there are still green shoots, and as I said, deals getting done. We've closed a significant amount already this year and have another 300 million under contract pending to close in the next couple months here. To Dan's point, I think the big question mark becomes how much distress is coming on the back of this year. Over the course of the next 18 months, there's approximately 22 billion in CMBS debt coming due or maturing at some point in time, at which the general feeling is investors will not be able to refinance because of the acceleration of cost of capital. What that ideally should equate to is a mark to market on the bid-ask gap that we're currently seeing right now and an influx of transactions on the back end of this year. Now, of course, not all of that 22 billion will come to fruition as it relates to landing on the market, but it'll be certainly interesting to see what portion of that gets worked out with lenders and what portion doesn't. From our perspective, we have seen our BOV or broker opinion of value activity accelerate in the past 2 to 3 weeks. We anticipate that will continue to increase. And again, kind of back end of this year is when we're anticipating, an influx of deals at more market levels. And when I talk about market levels, I think it's important to caveat that, 2020 pandemic hit, the world stopped. All of these groups raised capital for this element of distress to come to the market and pounce on the hotel industry, which never really came. through ways of federal handouts and checks and people traveling to drive to leisure markets, amongst others. Hotels rebounded and accelerated in a very fast fashion with improving performance across the sector. Meanwhile, capital, who had raised during that period to pounce on the so-called distress, saw that there was no distress and created an influx of demand into some of these markets and drove cap rates to very low rates across the industry. So, hotels that were trading at 8 cap during pre-pandemic were now 7 cap in some circumstances. The infiltration of that activity has certainly slowed, and we have, I think, reached a somewhat of a plateau in that type of transaction market. Now, larger resorts, full-scale properties that are in downtown CBD locations or beachside, certainly there are going to be low cap rates associated with that, so long as people are underwriting to mid to high teens, or in some case 20 plus IRRs on long-term holds, or feel confident in their basis of acquisition. It's just a very different story that we're hearing today. So, with that, I think I might toss it over to Joe for some insight on how his portfolio is performing as one of the largest owners in the country. And I can kind of interject from the transaction perspective and go from there.
Yeah, no, thanks, Spencer. All good remarks from you and Dan. Happy to be here today and give you some thoughts. I'll say this, kind of like summarizing, I guess the last 24, 36 months, our industry bounced back phenomenally fast during COVID. It was called the fastest bounce back, from prior peak to new peak, arguably in history. It took about 28 months to fully recover from COVID. That compares to 52 months or 59 months if you look at GFC or 9/11. So it really has been a remarkable turnaround from a period of time when we really didn't know if the travel industry was ever going to fully recover. So that's one great data point. The other great data point is really inflation, and I don't think we haven't talked enough about this lately. This is what makes us really bullish on the hospitality space. The gentleman on this call, Dan Lester, nailed it. He said that ADR was going to recover faster than occupancy, which is really the first time, I think, Dan, that's probably ever happened in recovery where ADR recovers that quickly. Usually occupancy comes back and ADR follows. But Dan nailed it, I think, ahead of everyone else. So kudos to you. And we're still seeing that fundamentally to today. I would tell you in our portfolio, occupancy is probably down anywhere between 3 and 6 percentage points versus 2019, but our rates are significantly up, call it in the ballpark of 10 to 20%, depending upon market and location, what have you. So we are above 2019 levels pretty handily. And the beauty of that is all of that rate flows through to the bottom line. So yes, wage rates are higher. Labor is probably up 20 or 25% over the past couple of years. Yes, utilities cost more. Yes, property insurance costs more. However, the fact that rates are up that much and labor is really only 25% of your payroll, at least at a limited service hotel. If we have a hotel that's doing $1 million more in revenue year over year, just round numbers, we're probably doing 500,000 or better, at the NOI level. So I would tell you, profitability on an absolute dollar basis is up above 2019 levels, and our margins are slightly higher as well. So from an operator's position, I think we're in a great place. And I can tell you, even with all the noise around the economy and where we headed, and soft landing, hard landing, who knows? But I can say 2023 is still strong. Year over year, we're probably up in the ballpark of 20 to 25% across our 150 hotels in the US. Occupancy is still down a percentage point or two versus 19 levels, but it's probably up 3 or 4% over the prior year. And rates kind of get you from 3% up to 20% up. So they're up, 17-ish%, call it year over year. So things are continuing to head in a positive direction. The comps are going to get harder. That is a fact. January, February, March of last year, we had Omicron that impacted not as much the secondary locations, but certainly, primary urban markets like New York, San Francisco, Chicago. Those are probably seeing huge gains year over year, and we're certainly seeing that in our New York portfolio. But look, the second half of this year, it's going to get a lot tougher. This summer, in particular last year, call it from like middle end of Q2 through really the end of the year, was pretty phenomenal. And it'll be very interesting to see kind of what happens over the coming like 9 months. But we still think when all is said and done, that we're budgeting or forecasting for kind of call it 10% RevPAR growth for full year 2023. What else can I tell you guys? I would say from a margin standpoint, we see the labor picture easing. What you saw in 2020 and 21, Amazon probably doubled their workforce across the US. Walmart did the same thing. They all took wage rates from 14 or 15 an hour to $18 an hour or $19 an hour. Those companies are kind of backtracking. Amazon has said a number of times that they've probably overhired during COVID. They've announced some layoffs. Walmart has a lot of companies like that. So we're seeing wage rates kind of normalize. People return to the labor force in the hospitality sector. We think that'll give us some tailwinds. So we'll stop seeing the pressures that we've seen in the past there. So we're pretty bullish on the outlook. I can also tell you the supply picture is phenomenal. And I mean, not from a new build standpoint, because we don't do that much new construction, but we do some, but it's extremely difficult to finance construction projects. The supply chain is an absolute mess. It used to take 11 or 12 months to build a limited service hotel. That probably takes 18 to 24 months now. And costs are, I've already kind of described the inflation impact, but we were bidding a Home2 project the other day in what I would call is a non-expensive Southwest market in kind of like a Vegas type profile. And construction costs from Jan 2020 to today are up about 29%. So it used to cost $150,000 a key to build a Hampton or a Home2 Suites. That's probably $180,000 or $190,000 a key now. And I think when people look around and fundamentally see that hotels are transacting south of replacement costs on a pretty routine basis, that means that a lot of projects were supposed to get built won't get built. Doesn't mean it's going to happen everywhere. It's kind of like the hammer and nail effect in our business. Some people build hotels. That's what they fundamentally do. They're going to keep doing it. But you know, if the long-term supply picture is called like 2% every year across the U.S., we really think over the next like couple of years that it'll be in kind of like the 1% like plus or minus range in terms of properties that are actually delivered. Now there might be some impact from like conversions. There's been a few new brands like Hilton Spark and what have you that'll be more competitive. But I think when you boil all that up, the positive top line fundamentals, the impact inflation's having on our business, an improving labor market relative to the last 2 or 3 years, and a supply picture that's arguably much better from an operator standpoint than it's been in the past. You know, we're very bullish on hospitality at large. And look, we invest in hotels because it's a rising tide. If you look over the past 30 years, as Dan said, it's highly correlated to GDP. I think the RevPAR CAGR for the US since the 1980s is about plus or minus 4%. Like I said, supply is 2%. So, you know, hotels are a rising tide in our opinion, and that's why we do what we do.
So Joe, as one of the largest owners, you guys are often active and have been throughout the pandemic and even through today on both the buy and sell side. You know, so maybe talk a little bit about what your outlook is or how you guys are thinking about both acquisitions and dispositions and what is an extremely interesting time right now.
It is very interesting. Spencer is right. We are active buyers. We have a series of funds where we've bought 50 plus hotels over the last 2 years. I can tell you the capital out there is very real. We're in the market today on both the buy and the sell side. And the stuff that we're seeing is transacting at, you know, people say, oh, I got to buy this at an 8.5 cap or a 9 cap or a 9.5 cap for it to make sense, you know, relative to my cost of debt. And I can tell you fundamentally that hotels in the right markets, in the right age, with the right product, that they're still transacting at like 8 caps or better. I believe that. You have a residence in Phoenix or in Miami or in Tampa or in Austin, those hotels are not trading at 8.5 caps. They are trading at 7.5 caps or better. Does it make sense logically as a buyer that like, you know, like how is someone doing that given where debt's pricing today? You would say mathematically no, but there's capital in the world. Capital has to be put to work somewhere, and it's going to hotels. I think largely because of the inflation thesis. Like people are still bullish on those cities from a demand standpoint, and inflation is real, and people have capital to put to work. So why not put it to work in an asset like that is an inflation hedge, where you're not locked into a 5, 10, or 15-year lease, that you have, relative faith that the cash flow is going to be better there than multifamily or industrial or different product types. So yeah, I would tell you it's still a very healthy transaction market. That does mean that people on the buy side, whether it's private equity funds or public or private REITs or foreign buyers that might be looking for mid to high teens type returns, it is harder. Like I think some of that capital is waiting to see what kind of happens and where are we headed in the world. But I just fundamentally believe people are willing to buy the right product in the right location, and it's still relatively healthy. Deal sizes are smaller. Big banks and the CMBS markets aren't particularly active today. If you're getting a $50 million loan, odds are you're going to a debt fund, and that money is kind of expensive. So you're seeing smaller deal sizes, I would say, and Spencer can probably speak to that. 20, 25, $30 million assets being financed by local or regional lenders at more efficient cost of capital. But we'll see. Maybe the second half of 23, some of these bigger banks start to participate again, and that changes the landscape. But for now, I think you're seeing a lot of smaller transactions.
Yeah, I think that's 100% right. And Joe, to your point, right asset, right market. No secret, during the pandemic, we saw flight to tax-friendly states, and it has followed the exact same suit from a hotel transaction perspective. High tax states, Chicago, New York, anything with the sense of union or, untax friendly is always going to be looked at in a very different light from an investment of capital perspective than Florida, Texas, Nevada, New Mexico, et cetera, where you are seeing sizable demographic shifts as well. And that's continuing today. And to Dan's point, I think we're naive if we think that there's going to be a 100% return to office in a pre-pandemic norm. However, if you think about that, what it means on a revenue perspective, and considering what Joe just said, that occupancy is 3 to 6% off, but profitability is still up. From a hotel perspective, you don't necessarily need occupancy to be at 100% of where it was to be well beyond peak, as rate has just pushed and pushed and pushed. So that's the really big question mark, is where we ultimately get back to, and how often people wind up staying home versus going into the office. Or to Dan's point, the word he hates is buy leisure, right? But people really are starting to blend the work week with the weekend, and we've seen a sizable shift from a demand perspective in that across all markets in the country.
Yeah, I think it's staggering to think about like the haves and have-nots when you look at the U.S. Cap rates in places like Phoenix and Nashville suburbs, or anywhere around Nashville or Austin, probably 7.5 cap or tighter. Cap rates in the Midwest, Chicago, Minneapolis, like you kind of name it out there, probably 8.5 cap, if not like far higher at this point, maybe 9. There's probably 150 or 200 basis points of gap between like those kind of markets. And I don't think it was that high historically. Yes, the higher growth locations like a Florida was priced tighter than the Midwest on a cap rate basis, but I think in today's world, that gap is even wider. And I'm kind of curious to see, if that normalizes going forward. But it's kind of a tale of two cities.
From the valuation side, REIT transactions, that's the big question mark, right? It's cap rates versus discount to replacement, and what the true value of that is. If something happens to be a 7 cap, but it's 100 a door, it's going to be a lot more attractive than potentially a 7.5 cap at 175 a door, right? Depending on where the market is. So it's an interesting time to navigate for sure.
I'd like to just jump in to Joe's point about haves and have-nots. It really is a dichotomy across America. And, while I, at least, and I think, my colleagues here as well, have been talking sort of generally, it's really important to never forget that the hotel business is a neighborhood street corner business, right? And you can't just look at sort of national averages. You really can't even look at metropolitan market averages, right? Manhattan is a very different market than Northern Jersey or Long Island, right? You really need to look at submarkets. It's really important. Another thing I just like to sort of bring up, just in the event that there are some folks listening that may be new to the hotel space. We've been talking in our lingo and RevPAR. So RevPAR is revenue per available room. And, I was talking about occupancy, Joe was talking about average rate, and you really need to look at the yield, right? Occupancy in a vacuum or rate in a vacuum is immaterial. You need to look at the revenue per available room, which is occupancy times room rate. Another thing I'd like to just kind of throw out there too is talk about haves and have-nots. There have been a slew of real trophy transactions that have occurred in the past couple of months, whether it be the Four Seasons in Jackson Hole or the Montage in Laguna or the Four Seasons in Scottsdale. These are really one-of-a-kind assets that nobody's building more of that anytime soon. And these assets have traded at very, very healthy numbers. So again, something to sort of keep in mind. And one more thing I want to kind of throw out there, we've been talking about cap rates. The reality is for institutional grade hotel real estate, investors do a discounted cash flow analysis where, it's a forward look, right? I've never met a hotel investor and or operator who didn't think that they could do better than the prior regime. Right. And I'm sure Spencer would validate that from his perspective, right? What does he sells the dream, right? And that's kind of what hotel investors are looking for. They're looking for upside. So they price assets on a discounted cash flow basis, whether it be 5, 7, 10 years, and then back into the implied cap rate. And, that's another thing to kind of remember, right? Cap rate, right? Which level of NOI are we talking about? Are we talking about after reserves? And if so, how much? After management fees, how much? Are we talking about in place, year one, stabilized, deflated? So, kind of have to be careful when you talk about cap rates in the lodging space. Just wanted to throw that out there.
Yeah, I think to Dan's point, transactions is very much a forward-looking analysis. So, the implied cap rate on today's NOI or net operating income is not necessarily reflective of the overall value of the property, which is why you have to take into account a variety of different factors. But, to Dan's point, there certainly has been a variety of trophy assets across the country that have transacted at, $1 million, $2 million. I think Four Seasons Jackson Hole was 2.5 million a key at a 6.6 cap or 6.5 cap. Montage Laguna Beach was 660 million at 2.7 million key. So, those are investments by big companies, obviously with a play on irreplaceable real estate that will cash flow in a prolific nature for, a considerable amount of time. Some of those are, I don't want to say immune to the cap rate analysis, but based on everybody's capital structure, they're approaching deals differently today. So it's really about understanding both your buyers and sellers' needs and really trying to match those today. And, it's, again, with the bank calamity we just witnessed this week, it's a big question mark in everybody's mind. So how that materializes or stabilizes, hopefully over the course of the next weeks, months here, is going to be very interesting from multiple perspectives in terms of where people are borrowing, where their lenders are lending, and where they're pulling out from.
They're also, the lodging sector is sort of notorious for attracting ego capital, right? And so we have seen no shortage of quote unquote trophy trades that didn't make a whole lot of sense on a cap rate basis, economic basis, what have you. I not counting the Sheraton Times Square, because I think that is a great opportunity at that basis. But I'm looking at another situation in a downtown Northeast urban core, 3-year-old property, beautiful asset in the most god-awful location in a god-awful market. It cost $400,000 a room to build this thing 3 years ago. We have trouble justifying $100,000 a room. What's my point? My point is that, it may be a great property, but even at 25% of replacement cost, it may not be such a good deal. So you can't automatically say, well, it's 50% of replacement cost, it's a great deal. That's not necessarily true. Joe, did you want to say something?
No, I was just gonna say it's a great point. We were talking about the lending markets, I think, at the beginning of that. God only knows where we're heading in the lending markets after the events of like the last 5 days. Who knows? They were already challenging to begin with. I think we like to say we've seen like the first pitch of like the first at bat of how this is going to unfold with like SIVB Is this an isolated issue? Is this one case where a bank got overextended, did some things they probably shouldn't have done, or overexposed to one segment called Silicon Valley in the tech sector, and then maybe should have diversified? Possibly. Is there some financial contagion that's going to impact regional banks? Are regional banks going to be more highly regulated like bigger banks? And is that going to restrict what they do going forward? Maybe, possibly. If that does that impact cost of debt and borrowing across the US? Are groups that have been like particularly active, like a Western Alliance on the real estate front, who is a phenomenal lender? I'm not saying anything about them. I think they are great, but are groups like that going to pull back? I don't know. I mean, you have seen a lot of capital and deposits get sucked out of the regional banking system and go to these bigger banks. I think Bank of America just issued a press release, said they picked up $15 billion of deposits over the last couple of days. That's come from Truist and First Republic and banks like that were very active real estate lenders. And now they've given it to institutions that are not lending to real estate. So what does that mean? I don't know.
And I think people are really going to have to gauge the difference between perception and reality, right? Who's to say what that actually is? But, you know, that's a perfect example. You know, Bank of America had 15 billion in influx capital. By the way, they just lended 5 billion back to First Republic.
Yeah.
Today. So, you know, I think you have a total of now 11 banks contributing 30 billion because they believe in First Republic, you know, to keep them afloat. And it's a seesaw.
And by the way, why are they not lending? You might say like, oh, they can get, you know, SOFR's like 4% or 5% or whatever it is nowadays. Who knows where Powell's taking us? But they can get a 350 spread over SOFR and make 8 or 9% on the money. Yes, it sounds good. However, they don't really know where the world is going, so they're a little scared about where we are in the cycle. And then B, I know I was talking to a certain large bank that I probably can't say who, but they would tell you in a certain year they get paid off on 25% of their commercial real estate book, 25%, a full quarter, and they take that quarter and they issue a lot of new loans to replace it. Last year they got paid off on 2%, virtually nothing. So if they're not getting paid off, they have less dollars to put out. The economic environment is uncertain. Maybe they just take that cash and sit on it. But without them bidding the market, it's basically a market of debt funds.
Yeah, I think the big question mark from both the buy and sell side is something's got to give.
Yeah.
And how long until we get to that period is still a question mark.
Steve, do you want to take Q&A?
Steven?
You're muted, Steve.
Okay,
Okay.
guess we can
Okay.
take the Q&A now. If
Why don't-
anyone has any question, please go ahead.
Yeah, go ahead. Any questions? Okay. I'd like to put out a question for an all-cash buyer of a family office that wants to come out into the market. What type of deals do you think that they would be able to accomplish today for quality hotels? Joe?
Spencer.
So Steve, let me just understand the question correctly. An all cash buyer, what kind of what? I'm sorry.
I kind of, high quality hotels wanting to come into the market on an all cash basis, foreign fund, family office. What type of deals do you think they would be able to cut today?
Yeah, so it's a good question. I think from the sell side, maybe Joe could attest this. Listen, having an all cash buyer is great. Financing is our biggest concern today. We need certainty of close, whether that's all cash or putting up non-refundable deposits at day one or signing a purchase and sale agreement. those are all healthy signs and things that we'll look for. The big question mark is, to your point, what is a necessary discount or applicable discount? It really depends on seller preference, motivation, and profile on a specific deal. I can't say for certain that it would equate to 5%, 10% discount on any deal, and it really depends on the competitive nature of the process being ran.
The Four Seasons in Jackson Hole was purchased by Host Hotels and Resorts. It's a publicly traded company. They bought it all cash, and I can assure you they got no discount for that. You know what they got? They got, as Spencer said, certainty of close that they were going to win the deal.
Mm-hmm. Okay. And there also the labor market, you said is needed in, and that would be of interest to these people as well, where they want to employ people. So I think that would be a viable incentive in markets where they have strong employment demand.
So I'm sorry, what's the question?
I'm just saying it would be also a factor that they would like to employ people, as many people as they have people to put to work. So they would like to be in the markets where they are in hotel in the industry where they can deploy people to work in the hotels, in the hotel market.
Okay. Not sure. Is that a question or you're making a
It's not a
comment?
question, it's just a statement. I think I think that would be, I'm just trying to qualify the buyer and say that that I think it's an opportune situation for them.
Look, I'll tell you this, the hotel is a high turnover industry business. Dan knows this, Spencer knows this, I see it every day. Average length of our employees is probably less than a year. So if someone has a pipeline of talent that they think they can fill a hotel with, I mean, that takes a lot of the operational pressure out of the equation. If we had a pipeline of talent to fill every one of our hotels every day and we could keep them fully staffed, that would be amazing, because I would tell you, we have hundreds of open positions across the country. So that'd be a huge advantage if you had a pipeline like that. That's my opinion. You're seeing a lot of contract labor across the US, I think probably in every market. Like I said, it's getting better from a wage pressure standpoint, but that still doesn't mean that we have every position filled. So I think that would be a huge benefit if we had that.
Excellent. Well, I want to thank you, gentlemen, for your expert effort this afternoon. You did a fabulous job, and it was IREON's pleasure to host this event for you. And we look forward to, we will send out the recording to all the registrants and all the attendees, so you can also dispense it to whoever you wish and share your knowledge and experience, which was quite evident. So I want to thank you again for giving IREON the opportunity to host this forum. And I wish everybody a good afternoon, stay healthy, and let's keep in touch.
Thank you.
Thank you very much.
Thank you.
Take care.